Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about long-term liabilities. As you hopefully recall, a liability is anything that is owed, the company owes to someone else. That's a liability. A long-term liability is something that is owed greater than 12 months. Short-term, 12 months or less. That within 12 months or less is short-term. Long-term, greater than a year, greater than 12 months. Examples of long-term liabilities. Anyone have an example of a long-term liability? Something that you owe greater than 1 year? Go ahead, Marina.
A mortgage?
Mortgage, yes, 100%.
Student loans?
Student loan, yes, unfortunately. Still paying mine back. Yeah, mortgage, student loan. Yeah.
Like a car.
Car payment, thank you. Yeah, very well done. Absolutely. Tilexis, not really. Credit cards, no. Those are actually current debts, current liabilities. Yeah, credit cards are current liabilities. Those are because the bill is well, it's revolving credit, so that's actually current liability. Good question. Okay, let's go ahead and jump on into it. So, when we look at financing for a business, we look at ways to raise cash in the business, right? We could do that through equity by issuing stock, which we talked about in the last chapter. Or we can do that by issuing debt, which makes a long-term liability, right? Issuing debt is done in a couple of different ways. One is you go take out a bank loan, and the bank loan will have an interest rate, will have a face value, will have when it's due, right? Another way of financing through debt is through bonds. Bonds are a very common way of financing through debt. A bond, think of a bond as like a private loan in a way, right? Through an investor. A bond is a form of debt that is taken on to finance, whatever the company's doing. And that bond is repaid over time. And it includes interest payments. Bonds are issued by both corporations and by governments. Your local government might issue a bond in order to make investments in various projects that the government's working on. And so they'll take out a loan through issuing a bond. And that bond is paid back with interest over time. Pretty much like any other long-term debt is. So the corporations issue bonds to the investors, and the investors are paid interest payments over time. And the interest payment amount is determined by the par value of the bond times the interest rate times time. I know it sounds funny, times time. The par value of the bond is the face value of the bond times the contract interest rate. This is the interest rate set by the bond itself. It's the interest rate, right? It's an interest rate times time. Time is the length of time the bond is expected to have. A couple of advantages of issuing a bond. Bonds do not affect control of ownership. It's a long-term liability. There's no equity involved here. Long-term liability is a bond. There's no ownership changes involved. There's no equity involved. It's just a bond. It's a liability. The interest rate on bonds is tax deductible. That's kind of nice, right? It's kind of like the interest payments that you make on your mortgage, tax deductible. And bonds can increase the return on equity because we're affecting liability and not equity. We can actually increase the return on the equity over time by increasing the liability. We'll talk a little bit about that. A couple of disadvantages of issuing bonds is that they require payments on a periodic of interest and principal at maturity. And bonds can decrease the return on equity over time, especially if we take too many bonds out. Right? Increasing liability usually decreases equity. Decreasing liability usually increases equity. We'll talk about it. Because remember, equity is the difference. You can rewrite the accounting equation, right? Assets equals liabilities plus equity is the accounting equation. The accounting equation can be rewritten as assets minus liabilities equals equity. So you're flipping the sign. Here's a bond, example of a bond. It's very similar to a certificate of stock, but a certificate of a bond has the number, has the amount, has the dates, the maturity date. Maturity date's when it's due in full. That's what maturity means. Bonds can be bought and sold. Very similar to stock. Bonds can also be bought and sold through these things called security markets. Security markets are very similar to stock markets. They act the same way. But the difference here is that the bond or the loan is being bought and sold, and the payment is expressed as the percentage of interest. And a bond can be bought or sold above the face value or below the face value. In this case, in this example, IBM stock is being sold at 103.8% of its face value. In other words, it increased because a bond was bought and sold. We're not going to get too deep into that, but it's important to get a decent understanding. Okay, so when the company issues a bond, they're selling a bond, right? We debit cash to increase cash because we're selling a bond, right? We're issuing a bond, selling a bond. We debit cash to increase our cash. It's like taking out a loan, right? And we're crediting bonds payable. Bonds payable because we have to pay it back at the maturity date. Payable, as you know, is a liability. Bond payable is a long-term liability, just like notes payable, long-term liability. So this example, we have our company has issued a bond at a par value, face value, of $100,000. The interest rate is 8%. We pay the interest rate to the bondholders at the end of June and at the end of the year. So 2 interest payments per year. The maturity date is in 2 years. So it's a 2-year bond, which makes it long term. It's greater than 1 year. We make 2 interest payments per year for the period of 2 years, so 4 total interest payments. The interest rate is 8% per year. So let's take a look at that information. So the first transaction is we receive the cash from the issuance of the bond, and we increase our liability by crediting. Now we start to make our interest payments. So we make 2 interest payments per year. First interest payment is on June 30th. We debit bond interest expense and credit cash to pay the interest. The amount is $4,000. How did we figure that out? We take the interest rate, 8%, times face value, 100,000, times half a year, which is 6 months. That's the amount of time. So it's interest times the par value times time. Half a year went by, and so we paid half a year's worth of interest. 6 months, which basically you could attribute that to 390. So 6 months, 6 over 12, right? It's $4,000. And we make that same interest every 6 months until the bond matures. So we do it 4 times. Because the bond is for 2 years. At the end of the maturity, so when the bond matures, it means that the face value is due. The principal is due. So at the end, December 31, 21, we are paying our bond payable, $100,000. So we debit bonds payable, $100,000 to reduce the payable, and we credit cash to reduce our cash, $100,000.
Professor, I have a question.
Yeah, go ahead, Marina.
So going back to the time, do we go by the 360 days or 365?
Oh, excellent question. So this is over 365, and the reason being is because we're taking into account whole years. So yeah, this would be 365. Excellent question.
Okay.
Yeah. When it comes to interest payments, yeah, the interest payments typically it's 365. For other factors, we use 360 when we're talking about bank stuff. But because bonds are typically held by individuals or other corporations, we use 365. If it was held by a bank, it would be 360. Excellent question.
Thank you.
You're welcome. Bond discount or premium. Okay, so just like when we issued our stock, we can issue bonds at above, at, or below market rate. Above, at, or below market rate. When I issue a bond above market rate, I'm issuing it at a premium. At market rate is at par value, and below market rate is at a discount. The reason why we do things like that is because I'm looking to either attract more bondholders or I'm looking to receive less cash up front to account for the interest payments over time. Now I'll explain both of those methods. When it comes to bonds, we amortize them. In other words, we schedule out the payments over time. Amortize. Just like you would do with your mortgage, you amortize the payments over time for the life of the mortgage. The same concept applies for bonds. We use this thing called straight line. You remember straight line when we talked about depreciation some time ago, a couple weeks ago, I think. And with straight line method, we talked about how an asset depreciates over time. The straight line means it depreciates the same value every year for the life of the asset. The same concept applies with respect to straight line over the life of a bond. We attribute the interest the same over the life of the bond each year or each payment. Let's take a look at the example of a discount. A discount, just as we discussed before, means that we're receiving less upfront. Okay, we're receiving less upfront. And we will pay back the face value over time because we're paying back interest plus principal. So if it's a discount bond, that means they receive less upfront. So let's talk about it. In this example, I got a $100,000 face value. They're going to issue 96.4% of that face value. That's at the discount. It's not 100%. In other words, 4.6% of that is being allocated to the interest payment. So we take the stated interest rate and the market interest rate, averaging those together to get if the stated is below the market rate, it's at a discount. The interest payment dates is at end of June and end of December. The bond date is December 31/19, and it matures in 2 years, December 31/21. So I issue the bond. I debit cash, $96,400. That's 96.4% of the face value. That's the discount, yeah? I debit this account called the discount on bonds payable. Discount on bonds payable, $3,600. The discount on bonds payable, it's an interesting account because it is a contra flow account. I'm sure you all remember when we talked about contra flow accounts. Contra flow account holds the opposite balance of the primary account, in this case, bonds payable. What that means is the discount on bonds payable normally holds a debit balance, and it is a liability account. Contra flow, right? We credit bonds payable for the face value. So you're probably wondering, how did we come up with the 96,400? 96,400 is the discount percentage that we got. So face value times 96.4%, which is 96,400 on $100,000. The discount amount is, of course, the difference. 100,000 minus what we got in cash equals the discount amount. Let's talk about the interest. The interest payments that we make twice a year, every year. We take it out of the discount payable. Why is that? Remember, we got less up front, the 100,000 less up front. We got 96,400 instead of 100,000. We got the discount amount. So that interest component gets paid out as it normally would, and when the maturity date comes due, it's the maturity less the discount amount, giving us the value of 96,400. I bet you guys are happy that this isn't a finance class, right? Okay. What's that, Dario?
I have a question.
Yeah, what's up?
So it's just that so anything like even referring back to the other chapters that oh my bad. The bonds always get credited, and then like if there's a discount, then that's what gets debited.
Yeah. So if there's a discount, it gets debited. So going back to this part right here, discount on bonds payable is a contra account. So remember how contra accounts work is that they normally hold an opposite balance. So it's just like when we talked about accumulated depreciation. Accumulated depreciation is a contra account to depreciation, which is an asset. And so it normally holds the opposite balance. So if there's a discount on a bond, it holds a debit balance. And then
Okay.
the
So
bond itself holds a credit balance.
everything else is usually credit, though,
That's right.
right? Like
If it's a liability, yeah. Yep.
Just the discounts are debits.
Correct. Yep. That's
Yeah.
why it's a contra account.
Gotcha.
Yeah. Great question. Okay. Okay. So we make our interest payments twice a year, debit bond interest expense, credit the discount to reduce the discount amount, and we credit cash. Let's see here. Oh, it's the amortization. So earlier we had said, just like you would a mortgage, we amortize the bond. Amortization is how we allocate the expense over time uh, through the life of the bond. And we use that using the straight line method. The straight line method means that we're basically doing the same amount per year every year. And this is an example of an amortization schedule. It shows us the amortized amount going forward. So we have our interest expense payments that are adding up to the face value at the end of the second year. So we started with 96,400. That's the amount of cash that we got from the bond, the discount bond. They had $100,000 face value. We make our interest payments, which are that's the unamortized discount, right? We make our interest payments. As we make them, we see that the interest goes lower and lower as it gets closer to maturity. And at the end of that second year, we reach our face value. That's what an amortization schedule looks like. What if it's a premium? Now we talked about discounts. Discounts is when we get less cash up front, and premium is when we're paying more for the bond above market rate. So let's use our same example that we did before. We got our par value, 100,000. The market rate is 10%. The stated interest rate is 12%, so I'm paying a premium on this bond. The interest dates are end of June, end of December. Bond start date, December 31, 19, matures 2 years later, December 31, 21. So I have an issue price of 103.6%. 103.6%. That's my issue price. 103.6% of par value. So how do I find out how much cash I'm getting? I take the face value times 103.6%. That gets me $103,600. Makes sense, because that's 103.6% of 100,000 is 103,600. So I debit cash 103,600. I credit the premium on bonds payable 3,600, and I credit bonds payable 100,000. Remember, the bonds payable amount will always be the par value, the face value of the amount. The difference is going to be either the discount or the premium. If it's a discount, it's a debit. If it's a premium, it's a credit. They're both contra accounts. So the maturity value is 100,000, face value, plus my premium, 3,600, gives me my total balance, also known as carrying value, 103,600. So the first transaction is I receive my cash, debit cash, 103,600, credit my premium, 3,600, credit my bond payable, 100,000. Remember, the bond payable is always going to be the face value. The premium or the discount is going to be the difference. How do we figure out how much interest is paid per period? We take the 4 payments. There's going to be 4 payments for interest, right? We pay it twice per year. At the end of June, end of December. The life of the bond is 2 years. So we take the face value times the interest times half a year times 4 payments. Gets us $24,000. It's $6,000 per interest payment minus the premium. Remember, there's a premium involved. So $24,000 minus the premium equals the total interest expense, $20,400. I divide that amount by 4 interest payments to get interest per period, $5,100. So at twice per year on June 30th and December 31, I debit bond interest expense, $5,100. I debit bond premium, premium on bonds payable to reduce the premium amount. And I credit cash to reduce my cash. And this is the amortization schedule on a premium. We see how the interest over time goes down and the carrying value goes down over time to get down to the face value. Face value is the same as par value. 612, where do you see that? Marina, where do you see 612?
Oh, sorry. I was trying to answer the question when you said I had to multiply half a year.
Oh, got you. Oh, sorry. Thank you. Thanks for helping Mark out. Yes, 6 over 12 is how we get half a year. Yeah. Excellent. Thank you. So at the end of the life of the bond is said to retire, right? It's at the end of the life of the bond retires. In other words, we take the bond off our books. The bond no longer exists. So we pay the bond. We pay the face value, the maturity. So at the maturity date, at the end of the bond, we record the face value. We debit bonds payable and we credit cash because we're paying the face value of the bond. It's probably the easiest part of the transaction. If the carrying value is greater than the face value at the end of its useful life, or before it's the end of its useful life, it's a gain. If the face value is less than the retirement price, then it's a loss. So here's an example of that. The bond value was $100,000. At the end of that bond, in this example, we had a remaining value of $4,500 from the premium that we got on the bond. So we would debit premium on bonds payable, $4,500. We would credit, because remember we're still paying the bond plus whatever interest is left, or whatever premium is left. We credit the gain on the bond retirement, $1,500. And we credit cash, $103,000. You don't have to worry too much about it. It's good to know, right? Good. Conversion. Sometimes we'll convert a bond to stock. The reason why we will convert a bond to stock is if the bondholder and the company agree to convert the bond to shares of stock. They happen from time to time for various reasons. here's an example of it. $100,000 bond value of Converse, the shoe company, has a carrying value of 100,000, and it's converted to 15,000 shares of stock at $2 par value common stock. We debit bonds payable 100,000 to reduce the payable. We credit common stock 30,000. How 30,000? $2 per share, 15,000 shares. Credit common stock 30,000, and we credit paid in capital in excess of par 70,000. That's the difference, right? So in order to find the paid in capital amount, all you do is you take the bond amount minus the common stock amount. Okay. As you recall, notes payable are bank loans greater than 1 year. Notes payable. It can be less than 1 year if it's less than 12 months. That would be a current note payable. But long-term notes payable is a bank loan that's greater than 1 year. And companies can make loans to individuals, other companies, to others. A company can make the loan. Instead of the bank making the loan, the company can make the loan. Let's say they're lending money to someone else for whatever reason. The company would make the loan. So the company would make an agreement where there's an interest amount and the face value of the loan, and they're both paid on the maturity date. Remember, the maturity date means when it's due, right? We issue the loan, time passes, note maturity date is paid plus the principal plus interest is paid in one single payment. That's one option. Another option is you make regular scheduled payments of principal plus interest over the life of the loan. This is typically how mortgages work or things like that, right? We make principal plus interest, and it's the same amount per month, every month, until the end of the loan. And these payments are made on what we call installments. So in this example, the company made the loan, right? The company is issuing a loan to another individual. That individual is going to pay the company. So let's say we're the individual. So our company took out a loan. We 8%, and that's a 3-year loan. So we debit cash $60,000. We credit notes payable $60,000. In the notes, we have 8%, 3 years. Okay. So we got to figure out how much we're going to have to pay over the life of the loan. So you could use an annuity table, and the annuity table is we take the present value to find out how much our payments, our monthly payment would be for those 3 years. And that type of table just basically gives you the percentage, right? Take the present value factor times the dollar amount. A table's a table, right? So it'll give you the percentage times the dollar amount. So in this example, we started with $60,000. Our interest expense is $4,800. Remember the percentage, right? 8%. Plus the note payable equals the amount of cash that we'll end up using. And so the payment amount each year is $23,282. If you want to find it out by month, you just take that and divide by 12. which is typically how that works. Okay, so let's take a look. Let's say we have equal payments. So it's the same amount we pay at the end of each year, once a year. That's nice. We debit our interest expense. We debit our notes payable amount, and we credit cash. Now you'll see that the interest expense and the principal balance change from year to year. That's based off of the amortization schedule, based off of the present value. Present value is the value of the face at that point in time. So after the first year, 60,000 minus 23,282, and then we would amortize it from that point going forward. You really don't have to worry too much about it. It's just it's good to know information. You won't be tested deeply on something like that. Mortgages. Mortgages is the most common method, right? This is the most common notes payable over time. Mortgage it's promised to buy property, right? And so there's a contract with every mortgage, and there's an interest rate associated with it. There's the face value, so forth and so on, and it's amortized over time. So mortgages is the best way to think about it when we look at things, something like a bond or a note. There are a couple features to bonds and notes. There's secured and unsecured. Secured means there's an asset associated with it. An example of that would be a mortgage. You don't pay the mortgage, the bank takes the house. That's a secured loan. Okay. You don't pay your car payment, the bank takes the car. That's a secured loan. Unsecured would be something like a credit card. It's unsecured because there's no collateral. There's nothing attached to it, right? It's unsecured. Convertible and callable. A convertible bond or note means it can be converted to a different type of liability. So just like, remember how we talked about accounts payable? And accounts payable can be converted to notes payable. The same concept applies with bonds and notes. A bond can be converted to a note. Convertible simply, or a bond could be converted to stock. The idea behind it is that it could be converted to something else. If it's callable, that means that the bank can say, hey, the whole thing's due right now. That's callable. Term and serial. Term is the life of the loan, or the life of the bond, life of the note. Serial means periodic payments. Registered and bearer. Registered means there's a registration number associated with the bond or the note. A bearer means that there is a holder of the bond or the note. Oh, your favorite, Mark. I know you love these ratios, right? All right, this one's actually useful. Okay, I promise this one's useful. It's called the debt to equity ratio. This helps me as an investor to understand the risk of investing in a company. Basically, it tells me, does a company have the ability to repay its debt? It's called debt to equity. We take total liabilities divided by total equity. Both of these are found on the balance sheet, of course. Total liabilities divided by total equity. As an investor, I'm typically looking at something that's less than 1. Less than 1, it's usually pretty decent. Anything greater than 1 or close to 1 is a little bit more risky. Bond pricing. When bonds are priced, we look at the cash flow concept. And this goes back to amortization, how basically explains how things are amortized over time. At point zero is reflective of the beginning and end of the bond. Beginning meaning here's the cash coming in, the face value, and end is when there's nothing left, when there's no time left. So it's relative to cash flows over time. Remember, we use straight line for the interest payments. So $4,000 per month for, $4,000 two times every year for a period of 2 years for a $100,000 bond. And then, of course, the cash outflows at par value at the end of the bond life. So when we look at cash flows, we got cash coming in and out of the business for investing, financing, and operating activities. A bond is a form of financing activity, which is on your statement of cash flows. And we can use the statement of cash flows to track the cash outflows over time for a bond. And this is what this represents. You'll learn a lot more about that next week when we talk about the statement of cash flows. The present value. How do you find present value? Well, you use a calculator. But present value is the value of the bond at today's rate. So to find the present value, we take the face value, the interest rate, and the amount of time. To calculate the present value, you got to understand the interest rate and the number of payments over time. And so to find the present value, like we did with this, we took the face value times the interest rate times the number of times, twice per year over 2 years, giving you the number of times. And that's how we find the present value. Go ahead, Awa.
Yeah, so the present value is the same as the principal, right?
Yeah, so present value, in a way, yeah. I mean, that's technically how you would find the principal balance at that point in time. So that will give you that present value at that point in time. So yeah, that's another way of thinking about it. But it's more, the present value is useful for telling us how much we would pay, or how much it is, how much the face value is worth at that point in time. It's another way of thinking about it. Good question. And you can calculate present value for both discounts and premiums on bonds as well. Again, this isn't a finance class, so we don't dive too deep onto it, but it's good to know. If you do end up taking a finance class, you'll definitely learn a lot more about present value. And then earlier we talked about amortization. Amortization schedules are really useful to understand the carrying value over time, over the life of a bond or a loan. Okay, last part I want you to understand. This one's a little bit more important. Leases. A lease is an agreement between the leaseor and the leasee. It's kind of like when you rent an apartment, the leaseor is the landlord, the leasee is you, the tenant. And there's a lot of rights involved with leases. There's the ownership, there's transfer of ownership, purchase options. The list goes on and on, right? There's a lot of financing involved with leases. And so we need to record that over time. There's a couple different types of leases as well. There's operating leases and financed leases. With operating leases, it gives you the right to operate over time, like a rental agreement, or if you're leasing a car, that's an operating lease. If you're renting an apartment, that's a operating lease. It gives you the right to use it, which is different than financing. Another important thing to think about is pensions. The reason why we're talking about these things is because with leases, they operate over time. Financed leases is basically making the interest payments and the principal payments over time until you reach a point of ownership. With operating leases, you're just making the expense payment over time. So debit the expense, credit the cash. With pensions, employers contribute into pensions over time, and the pension programs, depending on what it is, helps to evaluate when an employee is expected to retire. And this goes in line. It's relatively similar to bonds. Okay, that, my friends, is the conclusion of our discussion on long-term payables. I'm sorry, long-term payable. Any liability? Comments, questions, concerns? Anything at all? Yeah, you all good? Are you all out to lunch? Okay. Real quick, I want you to understand a couple key things real fast. Where we are in the class again? We're in week 7. We're in week 7 out of 8 weeks. That means we only have 1 week left. Oh my! Actually, we got 12 days left in the course. So a little less than 2 weeks. So here's what we got going on. This week you have your Chapter 13 homework assignment, Chapter 14 quiz. As a friendly reminder, you have 2 attempts on all homework assignments and all quizzes. Even if the time has already passed, you can go back and retake one if you still have that option available to you. Remember, up to 2 chances for each homework assignment and each quiz. So if you want to earn a higher grade on previous homework assignment or quiz, go ahead and retake it if you haven't already. So, second thing, very important to understand. Next week's the last week of the course. You'll have a Chapter 15 quiz, Chapter 16 quiz, and the final exam. Oh my goodness gracious. Yeah, that's a lot of work. The last day of this course is October 17th. I cannot and will not accept anything past October 17th. I'm tied to university policy on that. So what does that mean for you? What should you do to be successful? You need to work ahead, okay? Please don't wait till Sunday night. That is not good. Okay, do not wait till Sunday night to complete your assignments. Please just don't do that. You don't want to be scrambling at the 11th hour on the last day to be taking a final exam. That's not good for you, not good for me, not good for anyone. So my recommendation, try to start now. Yeah. The final exam, it's open book, open note. It's not timed. It covers everything from week 5 to week 8. So that's chapter 9 through 16. 9 through 16, it's 20 questions, open book, open note. It's not timed. It's open right now if you wanted to start it. You can save it and come back to it. So my recommendation is to start taking a look at it. Just kind of get an understanding of what's on there. Start finding it in the book. Start planning it. Start planning it out. And I promise you, if you do all those things, you will be successful. The only way to pass this course is by doing the work, period. If you don't do the work, you won't pass, I promise. Some of you did not participate in the discussion board. I don't know why you didn't, because it's worth 5% of your grade. But if you didn't participate, you just lost half a letter grade. So think about that the next time you decide to skip something. Yeah. My recommendation is don't skip anything. And make sure you do the work and take your time with it. But don't take too much time. Don't be late. So I apologize about my rant, but it's really important that you all are on the same page with this. Most of you are doing very well in the course. There's only maybe 2 individuals that might not pass because they didn't do the work. And I said that in the very beginning. I said the only way you'll pass this course is to do the work. If you don't, you won't pass. So that's what's happening. So yeah, if you have any comments, questions, or concerns, you need help with anything, and I've said this every single course, you could set up office hours with me. You know where they are. They've been there the whole time, right? Under Start Here, select office hours. It's been there since we started this course. If you need tutoring, that's been there since we started this course, right there. If you need any type of help, you could always email me, call me, set up office hours. All that information's been there since the very beginning. So please get in touch with me if you need help. Aside from all those great things, thank you all so very much for your time today. I've always appreciated all of you. I appreciate your hard work that you've been doing. This has been a great class together. I'm looking forward to our last session next week. In the meanwhile, I'm looking forward to hearing from you. As always, stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you so much for your time today. Appreciate all of you. Take care. Bye-bye.